Hello, good afternoon, good morning, and welcome to our Q1 2023 market update and outlook. The first one of the year. There's a lot of great information that we will take you through. Thank you for joining us. I know there are a lot of questions that you all may have just with the state of everything right now. So as a reminder, we will have an open Q&A session at the end. Feel free to start adding your questions now and throughout the presentation into the Q&A module, and then we will moderate that at the end of the session today. So as always, once again, our speakers for today are Mazen, Ben, and Matt, our fearless three here that will take us through the content for today. We'll start with Mazen to give us an overview of the market as a whole, to dive into a few things, and then over to Ben and to Matt after that for deeper dives. So Mazen, I will hand it over to you.
Thank you. So good morning, everyone. I'm an economist at Uber Freight and an applied scientist, and I'll be going over the high-level economic overview. So I'd like to start with our Uber Freight aggregate supply and demand indices. So these are indices specific to the truckload market that measure supply and demand. And the reason we focus on the truckload market is that it's an early indicator of what will happen in other markets, but it's also the largest market in the US. So our supply and demand indicators are aggregate indicators of the main factors driving supply and demand. So for supply, we look at a weighted index of trucks, how many trucks are there and how many drivers are there. And for demand, we look at variables driving truckload demand, mainly manufacturing output, consumer spending on goods, imports, and exports. So the last time we discussed this, we said that supply has been closing the gap with demand and starting to really outpace demand. And this trend continued in Q4 as well. So we saw that supply continued to edge higher than demand, mostly driven by an increased supply of both payroll drivers and trucks. So we saw Class 8 truck sales increase, especially as supply chain constraints started to ease. So meanwhile, demand was falling across the board. So we saw demand plunging. If you look at manufacturing output, if you look at imports or consumer spending on goods, so all of these have been falling significantly in Q4. It is true that we saw towards the end of Q4 a surge in spot rates, but that is not reflective of the supply and demand dynamics. In fact, if we look at the difference between our demand index and supply index, that is very highly correlated with spot rates and should tell us where spot rates are heading, as we can see in the figure to the right. So what about December's surge in spot rates? It was just temporary and caused by external factors like seasonality, severe weather, and diesel prices. So there were no structural changes justifying that increase, and that's why we saw it disappear as we headed into late January and early February. So going into the details of demand, we're looking here at the ISM Manufacturing Index. So this is an index that measures either expansion or contraction in the manufacturing sector. And the threshold is 50. So we can see the PMI, which is the weighted average index, and the sub-indices, which correspond to production, backlogs, new orders, and so on. And recently we have been seeing like all of these plunging below 50 in the past few months. Which means that there's contraction across the board. So production is lower, backlogs are dissipating, and new orders are weaker month over month. On the other hand, we've been seeing a continued recovery in customer inventories, which are getting closer and closer to 50. The bright spot in this report is the index of prices. So if you look at like a year ago, this index was about 80 or 85, which indicates huge inflation in raw material prices faced by manufacturers. This has gone significantly lower to like 39 or in the 40s, indicating disinflation in the prices of raw materials. Data from the ISM report has been consistent with data from the Federal Reserve on manufacturing output, which just turned negative year over year for the past couple of months. If you look at the second large sector for truckload demand, which is consumer spending on goods, we see similar like weaker trends. So we see that spending on both durable goods and non-durable goods has been stagnant throughout 2022. in the past 2 months, we have seen weaker spending, like lower month-over-month spending, especially on durable goods. We're still above the long-term trends because of all the behavioral changes caused by COVID, but we are getting closer and closer to these long-term trends. There's a lot of headwinds indicating weaker real disposable income. So inflation has been eating into disposable incomes. In 2022 ended the year about like 2% lower year over year. If you look at inflation adjusted incomes, or real incomes as we call them, and we were like about 8% were below the trend. So if you look at like where real incomes could have been if COVID didn't happen, we're 8% below that trend. Especially spending on services also continues to recover. And as consumers are spending more on services, that leaves less money to be spent on goods. And consumers continue to eat into their savings. So they saved a lot during COVID. They've been using these savings to maintain high levels of spending. But over time, these savings are becoming less and less. So that's another headwind for demand. Now let's look at inventories. So this chart shows the change in inventories from a year ago, a quarter ago, and a month ago. So if you look at a year ago across different sectors, we see huge increases in the range of 10 to 30%. This represents the inventory glut that we saw last year, where we saw excess inventories across various sectors. However, in the past 3 months, retailers have been depleting their inventories. They recognize this glut. So as we can see, like especially in like 3 sectors, which are general merchandise, furniture, and department stores. So we see that inventories have decreased in the past few months. In the last month, not a lot of significant change. But I would say that the inventory glut is becoming less of a headwind to freight demand in 2023. But we're moving from a realm of high inventories to a realm of weaker sales, which is another headwind for demand. Now, if you look at the supply side, in previous webinars, we have focused on long-distance truckload employment or payroll employment as the best indicator of how much supply is there. And that sector increased significantly in 2022. We saw like 9% gain year over year. It stabilized towards the end of the year, so we will not be focusing on that a lot today. Instead, what I wanted to show here is what's happening in the long tail capacity or owner operators, small trucking companies. So this chart shows the authorities and revocations of trucking operating authorities granted by the FMCSA. So authorities represent new carriers coming into the market, and revocations represents carriers exiting the market because of either like low spot prices or high operating costs and so on. And we've seen the surge in new authorities that happened after COVID starting to disappear. Like the number of new authorities granted by FMCSA is becoming weaker and weaker every month. On the other hand, the number of revocations or carriers exiting the market is increasing month over month. And in the past few months, we have seen more revocations than authorities, which means that we have more carriers exiting the market than those entering the market. Now, a lot of those exiting the market are trying to enroll with large fleets as like company drivers or leased owner operators. But then we expect that these fleets as well, because of lower demand, will reach their hiring capacity. And then we'll start to see capacity exiting the market, which will drive the supply-demand balance. The last thing I wanted to show here is what's happening with equipment supply. So this shows the net orders of Class 8 trucks in addition to the builds or production and the retail sales, like how many trucks are sold. So usually in soft markets, we see that net orders are going down. In tight markets, we see net orders going up, as we can see here in 2018 and 2021. And these waves of orders are generally followed by waves of production. There's a time lag of about like 7 or 8 months historically, which is dependent on the backlog as well. So recently we have seen a surge in truck orders, which is not typical of a soft market, especially in the last 3 months. So if you look at the last 3 months of 2022, We saw one of these months had the record number of truck orders, and 2 months had very strong orders as well. This was mostly driven by supply rather than demand. So OEMs opened a lot of build slots to serve the pent-up demand for fleets that were trying to replace their worn-out trucks in the past 2 years. So as you all know, there was a semiconductor shortage, and fleets could not get access to the trucks they needed. Their fleets were becoming old and worn out. So all of this surge is driven by supply, where supply chain constraints eased. So OEMs were able to open these order slots to serve the pent-up demand. However, one caveat here is that this is not only for large fleets say that this is mostly for truck replacements. These replaced trucks or the old trucks are going into the second-hand market, so they might result in some marginal increase in capacity. So with that, I'll hand it over to Matt to go over the route guide trends.
Thanks, Mazen. All right, so Mazen just covered the state of the kind of the economy and the sort of the macro. I'm going to focus on what's happening on our platform. So my name is Matt Harding. If you don't know, I lead the data and analytics for the 4PL side of the business, and do a lot of work in markets and trying to make sense of what's in our system. So the first thing I wanted to cover was some of the long-term dry van trends. Dry vans, it's a proxy for some of the other modes. It's probably more correlated to the temp control side of the business. We'll get into some stats on flatbed and intermodal. But the big takeaway here is, and what we're looking at is our three key indicators. This data is derived by every customer we've had since, it actually goes back to 2015. So we have a long-standing data set that archives all of the aspects of how the business is performed. And what we try to do is normalize these indicators, which I'll talk about in a second, such that we can look at them over time. And even as our business grows, what is the market doing relative to our business? And these trends are very much aligned to all of the other macro sources of information. So it's a good source of information. The first on the left is route guide compliance. This measures the amount of freight that comes into a delivered state where the carrier and the rate came from the route guide. So that includes loads that are second, third tendered. If it's a route guide rate and a route guide carrier, we have visibility to that. The second index is the first tender accept ratio, and that kind of gives us a sense of the first tender accepting the load. And what that means is the route guide is the source of all of the information relative to procurement and negotiations. It's used to forecast spend. So that first tender accept is really important in terms of if you're getting the first carrier on a lane and they accept, then you're probably going to have some pretty good cost control and good performance. It'll be a negotiated carrier with high service, et cetera. So first tender accept ratio is in the middle, and then on the right we have trending inflation over primary, and that index is just a measure of it's based on the volume of the lane, so it's by shipper, by lane, and we are taking a sort of a time-based weighted average of what the primary rates are on a lane, and then when we're not getting the primary, we're making comparison for that period of time to say, for loads that were delivered that weren't part of a primary carrier, what was the additional cost? And so we sum up and weight all the cost deltas across those periods, and then measure that against to what shippers would prefer to spend when the route guide's performing. And so that gives us a sense of inflation, but it's an internal benchmark based on the route guide composition. And you'll notice if you look across each of those, they all sort of reflect similar information, maybe inverted. But on the route guide compliance, net, if you look at the 2022 levels, you'll see that those are in comparison to 2019. And that's our last week market. And you'll see the route guide compliance is really high. What comes with that and what's highly correlated is the first tender accept ratio, very high. And then the inflation, conversely, is very low. And so, so from a dry van perspective, the route guide performance is really high right now, and that's a result of all of these sort of external factors that Mazen has spoken to. We're in a very abundant market. It's not uncommon, and we see this in other areas where there's a glut typically follows a shortage. And that's true for any industry, for any product. There's gluts in semiconductors right now. There's gluts in all sorts of industries. And we're feeling that as well within transportation. This is new information, so we try to jazz up our updates, so we're not presenting the same information over and over again. And we can thank Ben for a lot of the out in the field on the spot commentary. So there'll be plenty of new material from him. But we wanted to add something that really kind of reflects just the nature of how systemic route guides perform over the markets. So let me explain what you're looking at really quickly. Basically, for every month since January, we're looking at the percentage of volume of a delivered load that was associated to the final number of tenders, right? So you'll see, by and large, for every mode, most tenders are the first sequence, the first carrier that's tendered takes the load. But what's really, really compelling is if you look further into the colors and as you go to the second, third, fourth, and fifth, you'll see that for van, reefer, flatbed, and intermodal, that first, second, maybe third carrier is taking the vast majority of the freight right now. So what this does is it takes a lot of pressure off the shipper community. Generally speaking, budgets are easy to hit. One of the challenges we see is how far down should we go in terms of rate compression, what's meaningful, what's a good, knowing the market's soft, what's a good threshold. Ben will cover some of that. We'll have to take some questions on that. But needless to say, the environment is much better. Shippers are, I think, with the route guides that are performing, really able to focus on the business and increase the service. And instead of focusing so much on cost and mini bids and getting capacity, making the best use of the capacity they have, and then further driving the opportunities and benefits for better performance and better resiliency in their supply chain. So definite change of pace there. And then from a rate perspective, so for any of you that haven't heard this preamble here, what we're doing here on the top row is we're only taking volume that has a systematically applied carrier with a systematically applied rate. We take the last 3 months of data for van, the last 6 months for reefer, flatbed, and intermodal, and we create basically a rating engine. It's an econometric model. That model is then applied an estimate across all shipments, even if it's not in the period, even if it's not contract. And we do this for a very specific number of reasons. First, we want to be able to compare costs period over period in terms of how rates are changing. Now, it's not necessarily your business's cost or an individual company's cost. On a given day, they might ship an average of 350 miles. The next day, an average of 500 miles for out-of-pattern shipments. We're not going to measure that inflation. What we're measuring is what's the market rate for those lanes, irrespective of how they're used. So this is purely rate. It's not volume. And what we're trying to do here with the black line is to get a sense of what's happening from a contract perspective. So when the system is functioning and the rate is being assigned to the load and that load is getting delivered, and that happens without any manual intervention or any need for auctions or any need for spot, what is that trend line? That trend line changes based on two components. One would be if route guides are performing as we know they are, then you're not into that third, fourth, or fifth carrier in the route guide. And then additionally, we know that maybe 10% roughly of rates that are coming into route guide status from a procurement event, those are changing on a monthly basis. So across the 200 plus customers that we have, they are running bids, they are entering in new rates into the system, and then they're executing on those rates. So that's what the black line represents, is the inflation from a contract perspective. And then if you look at the blue line, those would be the loads that go to auction, true spot loads. And the difference between the spot volume and the contract tells you the state of capacity. So if we look at a macro environment and we look at oversupply, undersupply, what does it all mean? Well, from a pricing perspective, all things equal, you can see the difference in rates from the black and the blue, and that tells you everything you need to know about the state of capacity, because as the blue line falls below the black, that means there's abundance. As it rises above the black, that means there's a shortage. And you can see in just the time frame here from January of last year, just how much change we've seen in the market as we went through 22 to the current time. The second row would be all of those trends combined. And I neglected to bring up the green line. That's everything that we can't categorize. That's, we call it manual. There's been a manual assignment to a carrier, a manual change to a rate. It's a small percentage of the data, but we separate that. The two main components that are most important are the spot FAM, which is auction, and the contract. Sorry to gloss over that. The next slide, or the next row rather, would be the combined inflation as a result of all of those categories over that time frame. And it gives you a sense of how much inflation has occurred or deflation over time. So you can see there's been a fairly precipitous drop for van and reefer. And then as far as intermodal and flatbed, they're downward trajectory, but off of peaks that go back to mid-year of 2022. The spot auction percentage tells you how much volume is going into the spot auctions. So definitely more for the van and reefer modes than the other two. But that's also flattening. And then towards the bottom, you can see the first tender accept for each of those equipment mode categories on the top. Right now, everyone's trying to call the bottom. When are we out of this? I thought it was interesting that we had the Fed chair and everyone else in the market missed the jobs report last week. And if you think about that number being close to 500,000 when everyone thought it would be less than 200,000, I think that's a very kind of a shining example of how difficult this market is to project. We've got all kinds of Federal Reserve activity. We've got different industries that are changing across time. Demand seems flat. Maybe it's slowing. We've got an abundance of supply. We certainly don't promote or want bankruptcies in the market. They are a natural effect when rates are compressed. And typically in these cycles over the last couple decades, that's sort of the next component to bring supply more in line with demand. Hopefully our demand profile changes and our economy heats up before that occurs and we can continue our growth, as a strong economy. But right now it's a very soft market for shippers. We would expect this going into the next 6 months. So with that, I will hand it over to Ben, and he'll provide his commentary on the final section here. Ben?
Thanks, Matt. Great information. As Matt said, the job report was a surprise. We have the lowest unemployment since 1969, the lowest unemployment in 53 years. Really an amazing statistic. So if we do get a recession, this is the most advertised recession in the history of mankind, but we've also, the consumer is really hanging in there. So if we can go to the next slide. So as we look at this, as Mazen and Matt have really demonstrated, we really know where we are right now. We know where we're going in the near term. The uncertainty is a little bit further out, of course. And so, we've come through, we've seen this steepest sustained drop in spot rates. And we've also see that historically contract rates follow that about 6 months. And that's exactly what we're seeing, as people source, as Matt said. I love FTR's active truck utilization. So we've gone from this historically high, 95, 98%, every truck had a home, really hard to cover surge, et cetera, to now we've actually moved below the 10-year average. So if a carrier has a truck and they have a driver, what's that utilization look like? We're now below the 10-year average. We're below 90%. So, it's really yet another clear indicator that it's a very soft market. So, some big questions being debated. When will spot market bottom? A lot of folks are starting to say summer. We're just kind of bumping along the edge, still have some weeks. This week was actually mixed. When our spot report comes out, we'll see that a couple regions were up a little bit, a couple down, and only a 1% drop. So do we level out in the summer? And then when you look at things like the Fed trying to do, what's really going to change this was with a large shipper in Atlanta last week. And we were talking about what signals we look at to see the market change. Big macro things like housing starts, unemployment, automotive, things that we look at that Matt shows us and Mazen shows us about trucking and transportation. So what we know is really one of two things is going to happen. Either demand's going to pick back up because maybe the Fed sticks a soft landing, or we have some capacity destruction because it's such a tough time to be a carrier and getting tougher. And we'll go to the next slide and we'll talk about that a little bit more. So if it's a pretty good time after some tough years to be a shipper, ocean rates are down, truckload rates are down significantly, capacity is great, LTL's starting to soften a little bit. We'll talk about that more. If you're a carrier, this is a tough time. But it's really a carrier by carrier, mode by mode. So most recent results we have, and not all the carriers have reported, but we pulled some. When you look at what's going on in the carrier community, what you see, first of all, is everyone's revenue is trending down. Fewer loads going at lower rates, fuel costs coming down. But operating income performance really varies by carrier and carrier type. And so if you're a shipper, you can't really look at market performance as you're evaluating your carrier base. You need to look at carriers. So you look at folks like Landstar, big national broker, lot of owner-operator model. They reported in Q4 that the number of loads hauled was down 5.5%. The revenue per load was down 7%. And you can see the impact on their net income down 16%. C.H. Robinson, very, very large broker, down 43%. And C.H. reported results really driven by lower pricing and volume. It was interesting when you read through C.H.'s fourth quarter report, C.H. Robinson, you see that while their line haul rates were down 21%, their line haul costs were down 24%. So even though what they're selling was really depressed, what they could buy was depressed even more. So their top line was hurt, but their margin on brokerage loads was actually held up pretty well. But net, because of volume and rates, net income down 43%. Then you look like at a carrier like Martin, and in the temp control largely, a lot of dedicated. They actually had a very strong 2022. So when you look, they had the strongest year in their 77-year history. And while fourth quarter actually showed a slight improvement, 6% over fourth quarter last year. So a little bit different model, a little bit different modal mix. And then you look at Heartland Express. I like to say, Heartland Express is a case of the strong getting stronger. And so a carrier that's always performed well, not only continued to perform well, but they did some large acquisitions, Smith Transport, CFI. So they're kind of building a juggernaut of really high-performing carriers. And as Heartland said, they have one of the newest fleets, tractors, trailers in the industry. They continue to invest. They continue to have a very strong model. Then you look at some of the purer carriers, Knight-Swift, one of the largest truckload carriers, Covenant. Even though they had some strength in areas, look at their net income, down 40% plus Q4 22 versus Q4 21. And again, same kind of things, volumes down, rates down, even though, and costs stubbornly high. You look, they had some things that offset, but their costs are still equipment, people, maintenance is still high. And then finally, you look at J.B. Hunt and Schneider. Their net income was also impacted, but Schneider continues to move to a multimodal model. J.B. Hunt is really far along in the multimodal mode. Not as much a truckload carrier as they're a diversified carrier. Over the road, real strong dedicated, intermodal, so LTL even. So they have this mixture of modes. And so while their net income's down, it's not down as much as, say, a pure truckload carrier. So again, you can see the stress in carriers. Rates are going down. Costs are stubbornly high. They really can't do as much with costs. They tweak it a little bit, and they're trying to, but they don't have the same deflationary pressure in their cost structure that we see in rates. So we can go to the next one. And then warehousing, just to talk about, the other key part of logistics. So really, if you summarize warehousing is still pretty tight. The regional warehouses are in the 95, 96%. We help a lot of shippers every week. There's still a lot of markets. If you're trying to take down new warehouse space or move from one warehouse to another, it can be very difficult to find public warehouse space. And then a lot of the large shippers, large retailers, other folks that took down a lot of contract space at higher cost in 2022, 2021. Some of those now have excess space, and they're looking for people to help fill. If they took down 700,000 square feet in the market with a long-term contract, they may be looking for somebody to help fill 200,000. So there's definitely changes in the warehouse market. Cushman Wakefield reports 70% of markets are starting to see reduced rents. Cold chain's very different for our shippers who are active in the cold chain. It remains very, very tight, very limited space in the cold chain. And then if you look at the outlook, what we're seeing is there's a lot of projects coming online, so there's capacity coming online, but the pipeline of new projects is starting to slow down. Prologis forecast, a drop in development. So two things I'll share before we leave, kind of talking about warehousing. It's really interesting. If you look at 1970, 21% of U.S. adults had completed 1 year of college. Today, over 70% of high school grads go immediately to college. So the young folks graduating today don't want to go into a warehouse. They don't want to operate a forklift. They don't want to drive a truck. Now, not all those folks graduate. As a matter of fact, a high percentage end up dropping out of school. But first year out, there's this real shift where everybody goes to college, virtually everybody. So that's making it a more challenging pool. And that's why we see things like robotics and automation in warehousing. And then the last thing, with labor and space leveling off, but still not a tremendous drop in rates, you can't negotiate your way to success in warehousing. You really have to work, as we do with shippers, with our consulting group, is how do we make our warehouses more efficient? How do we design them? How do we get better use of the space? How do we ease that demand on labor? And how do we look for more automation? So just two more quick slides. Talk a little bit about LTL. The LTL carriers didn't get the memo on lowering rates. And so we see this really interesting situation where if you talk to shippers, a lot of shippers, that maybe LTL is a smaller part of their spend and they haven't been focused on that. They're starting to focus on it. But if some of those shippers did a bid, they expected kind of similar results to truckload. They're not seeing that. So if they expect large rate decreases, they may even see rate increases. And so it's more a matter in LTL of the percent of rate increase going down than it is seeing any kind of savings like we see with truckload. And what we see with LTL, where if you're really putting out a truckload bid, you're probably going to see very good results across almost any shipper, any mode. With LTL, there's fewer carriers. The LTL carriers really have pricing discipline. They're keeping that. And it's very much a bid by bid, carrier by carrier, shipper by shipper. What results will you see? But as the LTL carriers do have a little bit of capacity and do see some softening, they're looking at freight that matches their network. They may get more aggressive on price there. But just as they've done for the past few years, if there's freight they don't want in their network or doesn't operate well, they're going to price it accordingly. So we expect to see some softening. And what we're seeing, and you'll see that in the next slide when we talk about what we see shippers doing, we do see a focus on LTL. We've got more LTL projects starting in our consulting business right now than we probably have in any quarter. So people looking to do bids, to decide, should I continue to have my LTL outsourced? Should I bring it back in? Should I actively manage it? If I am managing it, should I outsource it? So there's a lot of work right now on LTL because that's an area where folks may not have focused as much, and they can go back now that truckload's in a little bit better shape, ocean, and focus on the LTL. So transitioning from that, what other projects do we see shippers doing? So what we see is very clearly a big focus on bids and procurement. And so either an annual bid or a shipper that may not have bid doing a bid or quarterly bids. But we also see more debate about how to bid, when to bid. Do I bring my bid up a little bit earlier? Do I align it with my annual budgeting so I can do a better job of really knowing what my rates are going to be the next year? So we see a lot of people kind of aligning their bid cycle so that they're getting the bid results, slightly before their budgeting, so they have a better budget input. We see people debating, should I take it all out to market? Should I take part of it out to market? And of course, how do I balance this market opportunity with my desire to have network stability and still have strong core carrier partnerships? And then we've seen tremendous change. There's been more churn in supply chain the last year than in my previous 30 years. We were looking at our top 25 customers, and over half of those, we have new contacts. So we've seen a lot of change A lot of shippers are working on bringing in new members, getting them on board, training them, etc. And then leverage lean as a tool for cross-functional savings. We really see that optimizing networks. We're doing more network optimization projects than ever. So, we've got through this firefighting. We've got through this craziness in our networks. We've got through some of the supply instability. So it's really a time to kind of start optimizing the network. And then looking at warehousing, as we mentioned, it's still a tight network. We can do a little bit more to optimize inside the four walls, our network overall, and then productivity within the network. A lot of people are starting to look at that warehouse carrier interface. So from the end of the production line through the carrier, and doing a better job of aligning my dock capacity so I don't have carriers and drivers waiting. How do I make all that work better? And then inbound. We've probably got 3 very large shippers that we're starting an inbound transformation with in Q1. So again, it's kind of like LTL. My truckload, my ocean's a little bit better. I want to go focus on inbound, because if I haven't optimized that and haven't brought it under control and gained visibility, that's really a big area for me to improve performance and get some cost savings. And then a renewed interest in sustainability, green, carbon reduction, carbon capture. We help a lot of folks with that. It's a real focus for Uber Freight, and we see a lot of interest in that. So finally, the last thing I'd say, I was talking with a very large shipper, probably a top 10 shipper. We have a monthly call. We kind of compare notes on the market, and they said their focus really is getting their network back optimized, having a plan, being able to execute on that plan, network efficiency, and then also preferred shipper. And we see this. Our large, mature, progressive shippers have not abandoned preferred shipper. And so as they get their networks more efficient, a lot of them are really talking about, we all know there's a lot of network inefficiency in supply chains. We hold drivers up. Drivers can't use their full hours. It's not really an integrated planned network. We're gaining more and more visibility, but there's real opportunities to drive efficiency across the whole network. Collaboration, really using that driver resource more efficiently. We see shippers starting to try to forecast more collaboration, more following the bid. If I bid a lane and I thought it was going to have 200 shipments in a week and it's changed, or my supply source, do I let my carriers know? So that's the last thing I think we're very much seeing shippers, while they are able to take some cost out and restore some of that damage done to the P&L over the last few years, they still remain interested in core carrier partnerships, network efficiency, and trying to collaborate with other shippers and carriers. So that's kind of what we're seeing. Really great to be part of this, and we look forward to answering some questions.
Thanks, Ben. Thanks, Matt. Thanks, Mazen. Okay, we do have some questions that have been submitted. If you have a question, as a reminder, there is a question module that you can type into, and we will try to get to all of them. So there's a couple of, first of all, housekeeping. The presentation and recording will be shared out with everybody after the call. So no worries there if you didn't retain everything. We will make sure that we get this shared out with you after the call. A couple of questions. Mazen, we're going to go back to the beginning here, as you were talking about kind of trucks and the market for trucks and that sort of thing. We have a couple of questions around a question here from Rob Haddock. He's heard that older trucks are now running into replacement part supply issues. Have you heard anything about replacement part issues?
So nothing like data-wise, but we have heard like a lot of anecdotal stories like that. So we're also looking at the data from ACT Research on used trucks, what's happening in the used truck market. So if we look at these trucks, we see that their mileage and age are like at record high levels, which means that the trucks currently being sold to the second-hand market have like an average age of about like 9 years or so. If you look at 2 years ago, or 2020, that was about like 7.5 years. So there's a significant increase in how much these trucks have mileage on them and their age as well. And that should result in a lot of problems with parts and maintenance.
There's another question as it relates to kind of used trucks and the truck markets about Section 179 expiring. Is there any correlation with what you're seeing with used trucks and that's expiring?
Like I haven't seen anything on that. It could be a possible explanation, but we haven't seen like any data showing that. But yeah, like the explanations I provide are those provided by ACT Research, or what we see in the ACT Research report, which are like our main source of truth for the secondhand market and the new Class 8 trucks as well.
Perfect. Okay, thank you. And then Mazen, another question for you, just as I'm looking at kind of the earlier questions that came in. As we talk about drivers, are there any of the employment agency tracking, or have you seen any data that employment agencies may be tracking where drivers are as to where the drivers are going? Are they going to asset carriers, construction, last mileage, or warehousing as they're leaving the industry?
Yes, so we have seen a lot of anecdotal data as well from like surveys we do and so on that showed that they have been going to asset carriers. A lot of these have been going to asset carriers. So if you look at the two data sets that we usually look at, which are payroll employment and provided by the BLS, and the FMCSA data, which shows trucking authority revocations, we have seen them increase at the same, almost at the same time. So we've seen in revocations surging, which means carriers exiting the market, but at the same time, we have seen like the largest increase in payroll employment in the long distance truckload sector specifically. So which tells us that these carriers have been enrolling with large fleets. To answer that questions, we haven't seen like any publicly available data, but we have done like some research internally and anecdotal research showing that yes, indeed they have been enrolling with larger fleets operating in interstate truckload.
Great, thanks, Mazen. Let's see, Ben, coming to you on LTL carriers. What can shippers do to become more attractive to LTL carriers?
Yeah, that's a great question. And Matt Lowry, who runs LTL for us, we did a project a couple of years ago where kind of like what we've done in the truckload, we really worked on what it means to be a preferred shipper. And if you think about it, it's amazing. Here we sit and all this technology and everything else. Still, the biggest challenge in the LTL industry, if you talk to carriers, is they don't know what they're going to be picking up that day. Most shippers we don't have that visibility. We don't have that link. So they might go pick up 8 pallets. They might pick up 23 pallets. They might pick up a pallet. So we still have that gap. But when you look at LTL carriers, it's really about that would be a tremendous help if more people were able to tell the LTL carriers, here's what you're going to pick up today. Then things like, try to group, as we do procurement, we look and, we don't want every single shipment to go to 27 different carriers. The carrier needs to be able to get some decent density when they pick up. So how do you allocate your freight? And we have a whole list of other things that can make it more efficient. Things like packaging, of course, make a difference. If you're seeing a lot of damage, why are you seeing damage? Is it something you're doing in your packaging? Stackability, are there things that can be done? We still have a few shippers. It's rare that ask the carrier to do sort and seg on their own docks, and that certainly makes it difficult. But if anybody wants to, they can reach out to me or reach out to anyone else at Transplace. We can get you that list. Matt's done some nice work with LTL carriers to identify what can make someone a preferred shipper in the LTL world and what we can do to be more efficient.
Great, thanks, Ben. Matt, coming to you for a question here. Are you seeing any of the large shippers transition to rail to lock in yearly pricing?
I think, no, not specifically, but it's always an option to look for those solutions as inventory levels come up, as networks are more balanced, to sort of reevaluate where the fit is relative to cost and service. So I'm not hearing too much about that. Not so sure I would have all of the information out there on that front. I typically focus more on the drive-in and the temp control and those major modes. Ben, Mazen,
yeah.
Any thoughts?
Yeah, truckload to rail conversions are tough from an infrastructure perspective. You know, if you're a rail shipper, you're kind of a rail shipper, and so we are seeing some people as they look at networks, you know, trying to add in rail capability. It tends to be in certain industries. You know, we see some folks looking to transload, you know, to some, you know, to some facilities, but you know, it's tough. You know, probably we see more right now intermodal, but that's, you know, that's a very dynamic market. So there's still some efforts. Again, it goes back to some of this ties to sustainability and the ability to move things over rail and, again, get your network back aligned. So as the rail intermodal networks get back in flux after some pretty wild disruptions, you know, shippers are looking at, can I move some of these lanes intermodal? Can I move them back that way? And we do see some people looking at rail, but, you know, it's usually an infrastructure issue. Is my facility on a rail line? Is it rail capable? So there's a longer lead time in trying to move freight to rail if you haven't been a significant rail shipper.
Yeah, Carmen, just a couple thoughts to add to that as I think through it. What we're seeing is that reevaluation. I think from the standpoint of where we sit now and what we've been through you know, all the various chapters of COVID and the economy, it's pretty clear that the market is changing much faster. Possible reasons for that are just data availability. More participants know more about what's happening than they have in the past. If I go back 10, 15 years, markets didn't move as quickly as they do now. So I think from the general standpoint of evaluating options, it's really good to know what's available and to make those changes, but do so knowing that if there's another shock or there's a situation that comes up, what's the cycle time to uncouple that change? How do you track and measure when that decision may not be valid for a change in conditions? So I think, you know, Ben's points are all valid. You've got to have the spurs and the infrastructure and, you know, the connective hardware to make that work. But at the same time, opportunities that are presenting themselves now may in fact vaporize, or, you know, they may not be appropriate for what comes. And we know that when things change, they've been changing much faster than we've seen in past cycles.
Awesome. Thanks, Matt. Thanks, Ben. Maz, I'm going to switch gears here a little bit. Not sure if you have data on this or not, and again, can open this up to anybody, but we'll start with you. With onshoring of manufacturing, are you seeing less freight coming out of the ports and more freight originating at the inland domestic manufacturers?
Yes, so we are definitely seeing less imports, especially in Q4, Q3 and Q4 of last year. So we've seen imports going down 25% from the highs that we saw in 2021 and early 2022, basically back to the 2019 level. At the same time, we have seen an increased cross-border activity. Maybe like Matt and Ben can talk more about that. But we continue to see nearshoring and reshoring as well. We heard that like a lot of industrial parks are being planned in Mexico. Most of these are close to the border with the US. So we are definitely seeing this trend.
Matt, Ben, anything else to add?
It's a big topic.
Go ahead, Matt. First.
Yeah. I have like a figure here showing the decline in imports.
Perfect.
So this shows like how 2022 imports fell sharply in purple here, especially starting August, and they're basically back to 2019.
Yeah, the other thing I would add is we're continuing to see this port diversification. So there's a lot of movement to ship more to the East Coast, try to be closer, less coming through just California. And then we're talking with a large shipper this week, a large importer, and they shifted quite a bit to Savannah, but they're also moving more through New Jersey, more through Seattle, more through Houston, both to reduce the transit times and to reduce the cost, once you landed at a port but also just providing port diversity away from kind of everything, say, coming through Southern California and potential bottlenecks there.
And then there's a follow-on question here about container availability. I'm assuming just as we're seeing the market and where things are, containers are available. We're not in that 2020, can't find a container anywhere. Maz and Ben, Matt, anybody?
Yeah, there's still imbalances, so
okay.
there's still, we're still kind of recovering, and, the network, took a long time to get in balance. So there's not a general, but there's still imbalances. It's interesting, I've had a couple of carriers say this and saw it in the earnings reports, but carriers are really focused on trailer. I know the question was containers, but trying to get better trailer utilization. So I think you're going to see more focus in that. A lot of trailers have become storage. A lot of containers had become storage. So I think everyone is focused on, getting better utilization of those capital assets.
Yeah, and I don't have anything on containers in particular, but supply in general, when it comes to ocean shipping, is expected to increase substantially. So because of the surge in demand that we saw in 2021 and early 2022, we have seen a record number of orders for vessel capacity. I think about like 25% increase in 2023 and 2024. So this is supposed to keep capacity very relaxed for the coming years.
Mm-hmm. All right, great, thank you. Next question, Matt, for you. Getting back to truckload, what are the current regional differences in the U.S. to truckload supply and demand? Do any regions stick out as being stronger or weaker than the others?
Well, last year, the West Coast was definitely showing different trends. What's really, really interesting is how the economic impact is very consistent across all the markets. When we show those trends by origin, or in the case where we showed it by mode, van networks and temp control networks are very different. They operate very differently throughout the year. You have produce season, you have other things that affect temp control. You get retail season and other factors that hit van. And it's amazing to me how you can take subsets of the market information, whether it's geography or similar equipment types, and the trends are all very similar. I don't think there's trucks have wheels, right? So wherever they can go to maximize the profit, they get allocated, and it's just it tends to be a very fluid market. And so we're not seeing any differences or advantages based on where you are. There's always head haul and back haul markets that create difficulties, but those are driven primarily by plants and, where people live and other aspects with, changes in latitude and things of that. But we're not seeing any trends that are markedly different by region.
Great, thanks, Matt.
Yeah.
Ben, I'm going to bring this next question to you, and this might be the last because it's a big question, and I think it might be worthy of an hour worth of consulting with you. But I'll ask it, and maybe you can pull a couple of points up for us. How can carriers pivot in this down market with the rising costs of fuel and lower spot rates? What are the strategies that can be implemented to keep trucks moving and reduce deadhead due to sporadic availability of freight?
Yeah, I think that's a good question. I spoke to the ATA and some different folks, and I think, the relationship between the carrier and the shipper is very transactional, probably too transactional. And 3PLs, we've done a good job of bringing a lot of visibility to shipper networks. I think carriers can do a lot more to share data. Some do, but the majority of carriers, for a lot of reasons, don't share as much data about their network, and they don't integrate their planning with the shipper. And so if you go back to that earlier discussion of, how can we make the entire network rather than an individual shipper's network more efficient? I think carriers, particularly truckload carriers, the railroads and LTLs probably do a little bit better job with data because there's fewer suppliers and some of that. But I think truckload carriers need to be more proactive with shippers, and they need to bring data. I think if shippers understood the lane challenges, and I think there needs to be more active dialogue. So that's one thing I think carriers can do. is share more data about what their challenges are and where they've got challenges. And then there's a lot of interest in collaboration. So if carriers can get a conversation going, multiple shippers, and can bring network efficiencies, I think shippers are very interested. But the last thing I'd say, it just begins with data. So if you're a carrier and you've got challenges, I think you should be aggressive in talking with folks like Uber Freight about our network, Nathan Adams, Corey Allen, those folks who run our carrier management group, our engineering folks like Matt, who runs our engineering. We're very interested, but I think carriers, the short answer is they need to do a better job of sharing data and moving that from a transactional lane shipment discussion to what needs to be done to help their network, which will help the shippers. And that's where we can find more efficiency.
Yeah, just to add to that too, I think every carrier they have capacity where they can surge in their network, and they have higher service offerings, or they have sort of the low cost. And if you think of freight on the dimension of cost, service, and capacity, it's really about aligning your strengths to the needs of the market and knowing how that aligns. And a cost discussion is not the same as a capacity discussion. And rightly so, those differences in capability, when they're aligned properly, I think has the best value. You certainly don't want to force everything to a cost discussion when in fact there are other needs that are really important, customers that are really important, manufacturing facilities that have to be utilized. So there's a lot to it, and it really just comes down to aligning strengths, and as Ben says, the openness to kind of make those determinations and let the market work itself out. But everyone's different in terms of what they can do in the market, and the alignment is key.
Great, thanks, Matt. With that, we are at the top of the hour, so we'll go ahead and close this quarter's market update webinar. Thank you, Matt, Ben, and Mazen for presenting. As always, great insight and information here. Great questions from the audience. If we didn't get your question, apologize. Come back next quarter. Ask more questions. There's going to be, I'm sure, much different or additional information, if nothing else, that we will take you through. As a reminder, we will share out the presentation and the recording after, so look forward to that. Thanks again for joining us, and we'll see everybody next time. Bye.